You know, if you follow the markets, you are just constantly hit with these predictions of doom and gloom. But what if the loudest voices are, well, what if they're wrong? Today, we're going to dive into the work of legendary trader Larry Williams, who uses fundamentals and these really cool historical cycles to cut through all that noise. All right, let's get into his contrarian case for 2026.
First things first, we have to talk about the world we're all investing in right now. Williams makes a great point that we are basically swimming in an ocean of negative headlines, what he calls the purveyors of pessimism.
I mean, you've probably seen headlines exactly like this one from just last year. A 90% crash has begun. It's scary, right? It gets a ton of clicks, but as Williams points out, it was also absolutely dead wrong.
Or how about this one? From a really big name, forecasting the worst recession in a century back in 2023. And again, it didn't happen. This constant drumbeat of fear can be totally paralyzing if you let it get to you.
And one more, just to really hammer the point home. This kind of extreme talk, it creates this climate of fear. And Williams' whole argument is that before you can even begin to find a clear signal, you have to learn how to tune out this deafening noise.
So, that's the big question, isn't it? If all the headlines are just noise, where should we actually be looking for real, actionable signals about where the market's headed? Well, this is where Larry Williams' approach really begins.
He starts by completely ignoring the talking heads on TV and just focusing on two core fundamental indicators. These have a long track record of telling us about the real health of the market. So let's dig into the first one.
First up, we've got the price-to-earnings ratio. It's a classic valuation tool. You can just think of it as the market's price tag. Is it on sale? Is it fairly priced? Or is it way, way too expensive?
Now, what's really fascinating here is where we are right now. According to Williams, history shows that when P/E ratios get up above 30, you're in a danger zone. That often comes right before negative returns. But today, the P/E is around 23, which puts us right in a zone that has historically produced positive, moderate gains. So the key point here is we are not in the bubble territory the bears keep screaming about.
Okay, the second fundamental is the yield curve. Now, it's a little more technical, I get it, but it's an incredibly powerful recession predictor. Basically, its shape tells us what the bond market, the so-called smart money, thinks about the future of the economy.
But Williams simplifies it for us. Just look at the historical record. Before the major downturns in 2000, 2008, and even 2022, the yield curve was either flat or pointing down. And that's what's so different today. The curve is now pointing up, a shape that he says is historically bullish for stocks.
Okay, so the fundamentals, they're looking pretty constructive. Now let's get to the real core of Williams' analysis, which is this idea that markets move in these predictable, repeating rhythms or cycles.
The first major rhythm he talks about is the Edgar Lawrence Smith cycle. It's a roughly 3.5-year pattern that we see in stocks over and over. And fun fact, its discovery actually inspired a young Warren Buffett. As you're about to see, its track record is, well, it's pretty remarkable.
I mean, just look at this timeline. The cycle pinpointed lows right near the 2008 bottom, and then again in 2016 and 2023, all of which were, in hindsight, incredible times to invest. And according to this very powerful cycle, the next major buying opportunity is setting up for, you guessed it, 2026.
Next up is something called the employment cycle. It's not just about jobs, it's based on the number of people employed compared to the entire population. And Williams' logic here is really simple. When a larger chunk of the population is working and earning money, the economy and the stock market tend to do pretty well.
So what's the forecast? Well, this crucial employment cycle is projected to turn up starting in mid-2026 and keep rising all the way into 2028. This suggests a powerful, fundamental tailwind is just over the horizon for the market.
All right, the third and final rhythm is the money supply cycle. This one tracks a 6 to 7 year pattern in the expansion of money in the economy. And it just makes sense, right? When there's more money flowing into the system, some of it is going to find its way into stocks, and that pushes prices higher.
And wouldn't you know it, all roads seem to lead to 2026. The next big upswing in the money supply cycle is also scheduled to kick in that year. So now you have 3 separate, historically reliable cycles all converging on the same point in time, and they're all pointing to strength starting in 2026.
So, beyond these big, sweeping cycles, Williams also highlights a couple of specific data points that he believes the mainstream pessimism is just completely missing. Think of these as the secret clues that separate his contrarian view from all the noise out there.
He looks at the famous University of Michigan Consumer Sentiment Survey, but he doesn't use it the way most people do. He sees it as a powerful contrarian tool. In other words, when everyone is super pessimistic, that's often the absolute best time to be an optimist.
So check this out. Looking back decades, every single time this sentiment index has dropped below a reading of 60, it has been a fantastic long-term buy signal for the stock market. It flashed that signal at the lows in 2008, again in 2011, and in 2022. And guess what? It's flashing that exact same signal right now.
And then there's this, which Williams calls the shock of the year. Federal corporate tax receipts have skyrocketed by over $200 billion. Now, just stop and think about what that actually means. The only way the government gets that much more in taxes is if businesses are making massively more in profits. It's an undeniable sign of a profoundly healthy and profitable business environment hiding right there in plain sight.
So, let's put it all together. After cutting through all the noise, after looking at the fundamentals, the historical cycles, and these contrarian clues, what is Larry Williams' ultimate forecast?
It all boils down to these three key predictions. Based on all his work, he expects stocks to continue moving higher into 2026. He also thinks interest rates are going to come down. But, and here's the real contrarian twist, he sees inflation starting to pick back up again. It's a complex picture for sure, but one that stands in total contrast to all the doom and gloom out there.
And this really leaves us with a fascinating question to chew on. Is Larry Williams right? Are these repeating cycles the actual key to unlocking what's next for the market? Or is this time truly different? It's a powerful reminder that sometimes the most valuable insights don't come from the loudest voices, but from looking where nobody else is.